So have you wanted to buy your first investment property, but just feeling overwhelmed with all the different things you need to figure out that goes into it? I mean, let's be real. You got to know all the things about the marketplace, your goals, your criteria, how to figure out the financing portion, making sure you're not buying a dud, right? There's just a lot that goes into it. So I wanted to create this video for you guys where I'll take you through the entire process of what you need to figure out when trying to buy your first rental property, as well as help you understand the key decisions that need to be made at each stage. This way, if you're actually looking to pull that trigger and buy that first investment property, you'll know all of the key things you need to figure out, so that way you can go through them sequentially and actually be able to pull it off and buy that property. What's going on, guys? My name's Lior, and I'm a real estate investor out of Boston, Massachusetts, and I'm excited to make this video for you guys. I have so many people, so many different investors always asking me about the process of how I went about and bought my first rental property. And I know it's overwhelming, right? There's so many things that go into it, so many components that you just don't really think about that go into actually successfully executing and buying your first rental property. So I wanted to make this roadmap of all the key steps you need to be taking, and then that way you can go through them, make the proper decisions, and actually be able to pull off what I think is one of the best possible investments you can make. So with that, let's hop right into the process and get right into it. So before you even think about looking at property or going on Zillow and all that fun jazz, you need to figure out what are your goals, right? Because real estate can help you achieve different goals. For some people, real estate helps them achieve cash flow on a month-to-month basis. And that's fantastic, right? If you want to increase your month-to-month income, then certain types of real estate can certainly do that, right? You can buy property, have enough income coming in where you're covering your mortgage and your expenses, and still have some left over to take on as monthly income. But that being said, that's not the only reason why people buy real estate, right? Cash flow is certainly one aspect of it. You may also buy real estate for tax purposes, right? You can write off a lot of things when you own real estate. So if you wanted to maybe shelter some other income sources you have, real estate is another great reason to have that in your portfolio to help you on the tax side. The other side of it too is, let's say you've got a great income or you got multiple income streams and you don't even necessarily need another one from real estate, but you want to invest in a high quality market that you know in 5 to 10 years is going to still be there and generate still very strong returns. That's another great reason to invest in real estate, right? And if this is really relevant if you live in a major metro like I do in Boston, maybe you live in New York, maybe San Fran, LA, any other major city, right? Investing in such high quality markets, especially when you're downtown, right? Those can be fantastic long-term investments that don't necessarily produce monthly cash flow, but on a 5 to 10 year play can be amazing assets to own. So the point is, figure out what is your goal, right? What do you need out of real estate? What's the purpose you're gonna spend all this effort, time, money, resources on it? And then based off that, that's gonna be your first filter of, hey, what kind of property do I really want to look at? All right, let's go to step number 2, which is actually learning the numbers behind the property of your choosing, right? So let's say you wanted to invest for cash flow, fantastic, and you decide, you know what, I'm gonna probably look at multifamily because I know multifamily and these specific parts of town are pretty reasonably priced and I think I can cash flow. Great. So what you're gonna start to do is 2 things. First, you're going to start looking at pricing on the market online, right? You can just type in, go on any website like Zillow, Realtor.com, Redfin. I mean, there's a million of them, right? And you can literally type in those types of properties in those specific cities and start looking at them. Just start filtering through them, see what kind of price points exist, see what kind of square footage you're buying, how many units you're buying if you're looking at multifamily, and start to build a sense of that. What you're also going to do is also start to figure out the cash flow and the analysis side of it, right? So now, let's say you're looking at a 2-unit building. Great. Now you want to start to analyze how the cash flow is going to look on a month-to-month basis. Even if you're not investing for cash flow, right? Let's say you're buying a luxury condo downtown. You still want to know what are your numbers going to look like, right? Because you're likely going to finance that deal. It's not like you want to be losing money every month, right? So you still want to make sure that the numbers make sense to you, right? And a very easy way to do that is you can plug into an online mortgage calculator what your mortgage payments are going to be based on the price. You can look at taxes on the listings. You can make some easy assumptions about insurance and some easy assumption about maintenance costs, and start figuring out at a high level, hey, if I buy this kind of property, these are going to be my cash flow numbers every month. Does this achieve my goal that I'm looking at? Yes, no, right? Pretty straightforward. So again, whether it's on the luxury condo side downtown where you're not really going for it, or if you're going for a 2 or 3 unit where you want it to be a cash cow, start to analyze the deal, start to see what kind of numbers certain properties produce. And again, that's going to continue to refine your criteria, and it's going to refine exactly in your mind what kind of real estate you want to start looking at and going after. All right, the next step I would suggest is, if you're really going to be serious about this, I would start the pre-approval process. And the reason is you want to know what kind of price points you can actually have a legitimate shot at qualifying at, right? You don't want to look at properties at $1 million if the most you're going to get a pre-approval for is $500 or $600, right? That's not doing anyone any good, especially yourself. So my suggestion at this point is to start going to the pre-approval process. So what you're going to do is connect with maybe 1 or 2 lenders, and they're going to ask some basic information from you, right? They're going to ask for your tax returns. They're going to ask for basically all your financials in terms of any other income sources, any sort of debt you have. They're going to try to come up with a preliminary debt to income ratio. They're going to evaluate your credit scores, right? So if you don't know your credit score, you can look it up yourself on free online resources. My favorite is creditkarma.com. Great resource where it can show you your, a ballpark of where your credit score is at. If you've got a low credit, basically anything below 700, I would suggest you start working on your credit score. That's something you're certainly going to want to improve. There are loan programs that do work with credit scores in the 600s, but they're typically for owner-occupant loans. So if that's a path you're going to consider, that's fine. But if you're going to be an investor, you typically want to be above 700 because you're going to qualify for those loans and also get better interest rates the higher your credit score is. So if you need help with that, there's plenty of resources. But the gist is, right, you're going to want to pay down any extra debt. If you don't have a lot of credit lines open, evaluate that. You might need to open a few more. So just really make sure you've got a good credit score that can help you get that mortgage. So what's going to happen is the lender's going to compile all this information, right? They're going to take your credit score. They're going to take your income. If you work for a company, they're going to take your W-2s. If you're self-employed, they're going to take all your returns from the last 2 years. They're going to take bank statements, and they're going to basically crunch the numbers and give you a preliminary pre-approval based on all those financials. So after you do this process, you'll be able to see exactly what kind of price point you should be able to qualify for on a loan basis. So let's go to the next step. Is once you actually have the pre-approval number, right, you know what you can qualify for. Now it's time to really start going on the ground and start touring properties within your price range. And when you're going to start touring properties, you're going to want to pay attention to a number of things, right? You're going to want to pay attention to things like conditions of the properties, right? How do they differ from one kind of building to the next, from one location to the next? How do the amenities differ, right? Do certain buildings offer better amenities? Is parking really important for your specific area? Is in-unit laundry really important for your specific area, right? So you want to look at all those details. What about layouts and finishes, right? You need to know what kind of market you're serving, right? Do you need ultra luxury units that have super high-end finishes and open concept units? Or are you kind of looking at bread and butter, more blue collar types of units? You don't need anything amazing, just your typical kind of nice, decent kitchen. You don't need open layout concept, right? You want to be able to start picturing exactly what kind of unit you want in order to serve the tenants you think you're going to serve, right? As you go through this process, you're going to want to add in analyzing other rentals, right? So, you may be asking, well, how do I know whether I need ultra luxury finishes or whether I need open concept or whether I need in-unit laundry? Well, you're going to start to also analyze rentals in the area, right? So you're going to look at rentals and see what competing rentals actually offer and what kind of price points they offer, that, right? So if you know that if you want to rent your units for $2,500 a month because that's the numbers you have on your sheet, Well, you need to make sure for $2,500 a month, you're offering the right amenities, right? Because if the neighboring unit is offering $2,500 and they have in-unit laundry, they have really nice finishes, and they have parking, but yours don't, and you're trying to get the same amount, you're going to be in a little bit of trouble, right? So you want to do this market research on the ground and add the research on the rental side too, because you want to combine them, right? You want to figure out exactly what's on the rental side and find that in the building. So you're going to continue to refine this process as you look at more and more properties, and eventually you're going to be ready for the next step, which is actually submitting offers. And submitting offers is always a little bit nerve-wracking, especially when you do it for the first couple of times. So I've got a couple suggestions for you. First of all, I would connect with an investor-friendly agent in your particular marketplace, because if you've never even bought a home before, right, if you're going for your first rental property, even if you have bought a personal residence, investment property is always a little different, and there's always different factors involved. So again, my recommendation is connect with an investor-friendly agent. You can do so at Bigger Pockets. I mean, that's a great place to find agents that are posting, providing value, and those are typically the agents that work with a lot of investors. So that's tip number one. The other tip is you got to understand, right? As an investor, you're going to be writing a lot of offers, right? Because the way you're going to be analyzing these deals is you're going to be analyzing them from perspective, well, what are the numbers that work for me, right? I want to make sure I'm buying a deal that supports the cash flow that I need in order to make sense of the deal. So, whether that means you're going to be coming at asking price, over asking price, below asking price, that's a function of that specific market. But again, it all kind of comes down to, hey, I need to hit a certain return metric, so these are going to be my numbers. Now, the one caveat I will put to this, because I see this all the time, is if you read blogs like Bigger Pockets, et cetera, they've got great value. But a lot of the things you will see on there is advice like, well, you always need to come under asking. You got to be super, super tight on your asking price and not really negotiate. It's my way or the highway. And I don't really think that's always the right advice, right? Because you need to put this in context of your marketplace. So for example, if for whatever reason your numbers are telling you need to offer 15% below asking on most of these multifamilies, condos, whatever you're looking to buy, and it turns out that, and you're in a really hot market, maybe like Boston where I'm at, and everything is selling 5-10% over asking, you're gonna be putting in a lot of offers for a really long time and super unlikely to get anything done with it, right? So you need to kind of balance this perspective of, yes, I have my numbers and I have my set metrics, but if you're gonna be competing in a certain marketplace that's really competitive, and if you're coming in 10-15% below asking because that's what Bigger Pockets is telling you to do, I've seen investors literally put offers in for like half a year, don't get anything accepted, and then it discourages you, right? So my point here is, yes, you want to be aggressive on offers in terms of making sure they work for you, but you have to put that into context within your own market. If you're consistently just getting blown out the water and it's not even close, as a new investor, I can see how it can get discouraging. So I'll tell you my story, right? When I was new investor and trying to get my first property under contract, my first couple of offers, I was submitting offers like $50,000, $75,000 asking because of the advice I was reading on different blogs. And I wasn't even close, right? I mean, it was just not even close to getting a deal done. So it's only when I started playing to what the market had to offer, right? The market expectations and competing with others. Eventually I realized, look, if I'm actually going to buy this property, it's unlikely I'm going to steal it, especially on my first one. So it can be a progression. But again, the point here is put that in context. Now, again, I'm not saying that you should come in on your first or second offer like 30,000 over asking, just because you really want it that bad. No, that's not the advice I'm giving. My point is you're probably going to have to put in a good amount of offers. But just remember, put that in context of both what works for you in terms of a cash flow perspective and a numbers perspective, as well as in context of a market perspective, so that you do give yourself a good chance of getting a deal under agreement without driving yourself insane for like half a year or a year, putting in offers left and right. So assuming you finally get your first offer accepted, you're then gonna go to another really important phase, which is the due diligence / inspection phase. And more than likely, you're probably going to do a home inspection where you're going to hire a third-party inspector, right, to come in and actually inspect inspect the unit or inspect the building, whatever it is you're buying. Now, typically, the most important things I look for from a home inspection are results on the big stuff, like the mechanicals, the roof, the siding, the foundation, anything like that, right? Because if an inspector tells you, hey, you've got a broken dishwasher, you've got a loose faucet or something, I really don't, do you really care? Not really, right? I mean, this is going to be an investment. You're probably going to have those kinds of things come up all the time. But it's severe issues with plumbing, with electrical, if you've got a bad furnace, if you've got some issue with your electrical panel, those are things that can actually add up to significant sums of money and can really impact your investment. So during the home inspection process, make sure to focus on the really the big stuff, the stuff that can really alter your wallet one way or the other. Again, the smaller stuff, sure, it's important and it's good to know, but that's the part I'm least concerned about typically when I go to an inspection. Other things you may do during due diligence, if you're planning on potentially renovating the property, maybe you're doing like some sort of addition or anything of the sort, you might want to go and do your homework with the city, right? And confirm that any sort of idea or business plan you might have for that property will pass city code and you can get actually approved permits for that kind of project, right? Because you don't want to buy, let's say, a single family or two family that you were potentially planning on building an addition or something crazy like that, close on it, and then find out, the city's not going to approve those permits, right? That's not a position you want to be in. So those are typically the big things, is doing the home inspection and then talking to the city. You usually go to the city's building department and making sure that there's nothing crazy going on with the property. If you have any sort of specific plans in terms of construction, that you can more than likely get permits for it and that there won't be any major hurdles. And finally, the last phase is really just closing out that transaction. Once you do your due diligence, you're going to sign a purchase and sales contract. And then you're going to get the lender involved. The lender's going to do all their homework, right? They're going to go through all your financials in a lot more detail. They're going to appraise the property, make sure it looks good from a value perspective, and eventually issue the loan. The only thing you really have to be concerned at this point is, first of all, don't do anything stupid in terms of credit or taking on new debt, right? You don't want to open any new credit cards. You don't want to go take on a car loan, finance a big purchase, whatever it is, right? Those stuff during a transaction can really hurt you, and it could kill your deal. So just obviously be cognizant of that. Otherwise, it's really just the bank doing their thing. You can obviously get all your funds ready to close, and eventually you will get to the closing table and close on your deal. So hopefully that gives you guys a sense of some of the key steps you're going to take along your journey of buying your rental property. I think those first couple are definitely the most important, right? When you're really defining your criteria, understanding your goals, aligning that with specific types of properties, that is by far the most important, right? Because that is the goal of real estate investing, to meet some sort of financial objective. And then as you go and start learning about the marketplace, the different types of properties, all the amenities, finishes, everything we talked about, that's also crucial, because you want to make sure you understand the marketplace that you're about to invest in. So hopefully that makes sense, guys. If you guys have any questions, any comments, shoot them below.